Welcome to the Majestic Trader. Today, I'll give you an insider's perspective into institutional trading strategies for gold. I'm not just a trader, I'm an institutional investor who's spent years mastering the art of precision trading. We'll uncover the tools and tactics that professionals use to dominate the market, with a focus on technical patterns and strategies that drive results. Let's dive in and elevate your trading game. And one most important thing. Just listen to me carefully. It's a very important tactic that I am sharing with you. So just listen to me. Whatever I am going to tell you are the only thing that we use to consider entry into gold trade. Let's start with volume profile. For institutional traders, this isn't just a tool, it's a window into the market's soul. Volume profile shows us where the most trading activity has occurred across price levels. Why is this important? Because these high-volume areas, often referred to as value areas, reveal where institutional players like banks and funds are placing their trades. Take a closer look at a chart, and you'll notice clusters of volume. These zones are magnets for price. For us, they act as anchors. When the market revisits these levels, it's either confirming strength or showing weakness. This insight is critical for identifying potential reversals or continuation trends. Retail traders focus on price. We focus on value. By analyzing volume profile, we're not guessing where the market will go, we're calculating where it should go. Order flow and market depth are the tools that let us see beneath the surface. Most traders see candlesticks. We see the engine behind them. Order flow provides real-time insights into how buy and sell orders are entering the market. Are there sudden spikes in buying pressure? Is selling drying up at a critical support level? These signals often precede major moves, giving us an edge. Market depth, on the other hand, reveals where liquidity is pooled, those large buy or sell orders waiting to be executed. These zones act like barriers or magnets for price. If I see an enormous buy order sitting below a key support level, I know that support is unlikely to break easily. For institutional traders, this isn't optional, it's essential. Order flow and market depth allow us to track where liquidity is concentrated, positioning us ahead of the market rather than chasing it. Fibonacci retracements and extensions aren't just theoretical tools, they're practical and powerful when applied correctly. Institutions use Fibonacci levels to identify key zones of interest. Retracements help us determine where price might pull back before continuing its trend. The 61.8% level? That's not magic. It's a zone where institutions look to accumulate or distribute positions. Extensions, like the 161.8% or 261.8%, give us profit targets. Why do these levels work? Because they reflect the natural rhythms of the market, areas where collective psychology aligns. Retail traders often misuse Fibonacci, but institutions combine it with volume and liquidity data to ensure accuracy. This combination turns a simple tool into a precision instrument. Let's talk about double tops and double bottoms, classic reversal patterns that every institutional trader respects. When we see a double top form near a high volume area, it signals exhaustion in buying momentum. But here's the key: as institutions, we don't just trade the pattern, we analyze the volume. A strong second peak with declining volume tells us the buyers are losing steam, an ideal setup for a short position. On the flip side, double bottoms signal accumulation. Institutions often load up on positions during the formation of the second bottom. Why? Because these levels represent areas of perceived value where smart money is entering. We combine this with liquidity analysis to confirm that stops below the pattern have been cleared, ensuring a cleaner move upward. The head and shoulders pattern isn't just a pretty picture on a chart. It's a psychological battleground. When the right shoulder forms, it often aligns with reduced buying pressure or increasing sell-side liquidity. As institutions, we pay attention to the neckline. A break with significant volume confirms the pattern, but we don't jump in blindly. Instead, we wait for a pullback to retest the neckline before entering. This ensures our entry is backed by conviction, not speculation. Why is this pattern important? It reflects the shift from bullish to bearish sentiment, giving us a clear roadmap of where the market is heading next. flags are one of the most reliable continuation patterns in institutional trading. When gold makes a strong move, followed by a consolidation that forms a flag, it tells us that the market is pausing, not reversing. The key is in the slope. A shallow, downward sloping flag during an uptrend signals healthy consolidation and pent-up momentum. Institutions often use this opportunity to enter the market during the consolidation phase, ensuring their position for the next breakout. For retail traders, flags may seem like random noise, but for us, they're a signal to prepare for action. Breakouts are high-energy events, but institutional traders don't chase them, we wait. Before a breakout, we monitor the build-up, tight price action, declining volume, and an order flow imbalance. When the breakout occurs, it's the volume surge and liquidity shift that confirm its validity. But here's the secret: we prefer entering on the pullback. Why? Because a pullback to the breakout level often aligns with Fibonacci retracements, offering a low-risk, high-reward entry. Pullbacks are the hallmark of disciplined trading. By entering on pullbacks, we minimize risk and maximize our probability of success. Liquidity grabs are institutional bread and butter. They occur when the market takes out stop losses above or below key levels, creating a sharp move before reversing. Why does this happen? Because institutions need liquidity to execute large orders without impacting the market too much. By clearing stops, they create the necessary liquidity pool. As an institutional trader, I look for these setups deliberately. When retail traders panic and exit their positions, I step in, placing trades right where liquidity is strongest. These setups are incredibly powerful because they're fueled by emotional reactions, giving us a significant edge. Stop-loss placement isn't just about minimizing losses, it's about strategic positioning. Institutions don't place stops at obvious levels. We know retail traders cluster stops just below support or above resistance. Instead, we look for liquidity zones slightly beyond these levels. For example, if I'm entering a long position at a demand zone, my stop will be below the liquidity grab area, not just below the zone. This placement protects us from false moves and ensures our trade has room to breathe. Stop-loss placement is where precision meets psychology. It's not just about protecting capital, it's about positioning yourself for success in an unpredictable market. This is how institutions approach gold trading, methodically, with tools and techniques that align with the market's psychology. Patterns like double tops, flags, and head and shoulders, combined with strategies like liquidity grabs and disciplined stop-loss placement, form the backbone of our approach. If you're serious about trading like a pro, subscribe to the Majestic Trader and join us on this journey. Let's master the markets together, one trade at a time.